Hi, this is PR Sundar. Last episode, I spoke about how the bond prices move according to the interest rate. In the last 1 month, the entire world markets are in correction mode, and especially Nasdaq has fallen 10%, and the people say US bond yield rising. So what is US bond yield rising? What it has got to do with the stock market? Now, I'm just looking here on the screen where you can see the US bond yield is 1.557% and it is up 0.5%, and you can see US futures, US Dow Jones, everything is down. Now, what is the relation between the bond, the interest rate going up, and the stock market? So let me start from the basic. Now, what happens if there is any economic downturn, any problem, just like 2008 Lehman Brothers collapse, 2020 coronavirus. So whenever the economy is facing a very, very big problem and the people do not want to spend and they want to save for the future. So when everybody is saving, nobody is spending, and the products cannot be sold. If the products cannot be sold, the companies will not be doing well, the economy will not be doing well. And also because of these difficulties, the businesses will be down, and if the interest rate is more in the bank, they cannot service the interest rates. So what the banks will do, Central Bank, Reserve Bank of India, they will reduce the interest rate. Once reduces the interest rate, what happens? The cost of doing business is less for the people who are doing business. So that will encourage them to do more business, to produce more goods. On the other side, consumers will have less incentive to put the money in bank because they give very, very less interest. So why to keep? So they can, instead of saving, they will buy the goods. And let us say I want to buy a car. Let us say I want to buy a Benz car. If the rate of interest is 12%, wow, for 1 crore, 1 lakh interest every month I have to pay, I don't want to buy. But the same thing, if the interest rate is 6%, wow, 1 crore car is only 50,000 is the interest. It's not 1 lakh. So the people will be tempted to buy more when the interest rate is low. And when the people buy more, the more and more products will be sold, the economy will revive. So when an economy is down, the interest rates will go down. If you have been observing Lehman Brothers collapse, the US interest rates came almost to zero. Coronavirus, the interest rate almost came to zero. So this is when the economy is in very, very bad shape. And once that bad phase is over, when the economy is reviving, economy is doing well. When the economy is doing well means more people get jobs, more people get more money, and they'll be ready to pay more money. And because of that, inflation will go up. So to control the inflation, what the central banks will do, they will increase the interest rate. And everybody has a lot of money and everybody want to buy the product. But you increase the interest rate, some of them will think, when there is so much interest rate, oh, why should I spend the money for car? Better I put it in FD, I can get more interest. So some people withdraw from purchasing. So there will be less people will be buying. So the price rise will not be more. So this is the theoretical part, how central banks increase or decrease the interest rate. Now, there are two ways you can interpret anything. There are two sides of a coin. When the economy is good, the interest rate will go up. So how you are going to look at the stock market? Economy is good, more people are buying, the companies will be able to make more money. So that's good for stock market. So that is one way of looking at it. And if you can remember, 2003 to 2007, these 5 years, it was a fantastic bull run in Indian stock market. 2003, Sensex was at 3,000. 2007, Sensex was 21,000. It has shot up 7 times, 700%. But you remember during these 5 years in the economy, interest rate was keep going higher and higher. Those days RBI policy is only once in 6 months. Nowadays RBI policy is once in 2 months. Those days RBI policy was in once in 6 months. In every RBI policy they increase the interest rate. But still the market went so much higher. And there are other ways of looking at things also. So you can think, when the interest rates are more, people may put the money in bank FD. Why should they come and put the money in stock market? Because stock market is subject to market fluctuations, market risk. So you can look at that way also. So now what is happening right now, generally speaking, the rising interest rate is actually good for stock market. But however, this time the rising US bond yield, the 10-year bond yield in US, and making the markets very, very jittery, and the markets are falling. And why it is falling this time, contrary to the general expectation, I will be explaining in my next video. Just wait for my next video. Thank you for watching.